Welcome back. Now, Nedbank has posted a 10% rise in annual headline earnings per share. This thanks to strict cost control measures and a 17% drop in impairment charges. The total dividend is also up by 10%. Company CEO Jason Quinn joins us with his take on the performance. Jason, thanks so much for your time this afternoon. And as we get started, just put the year that was into perspective for us. I mean, on the macro front here at home, a lot happened. We had post-GNU optimism. We also had lower inflation and lower interest rates going towards the second half of the year.
Yeah, Taling, I think, let's be honest, the macros last year were pretty uneven, right? As you say, going back to that first quarter, there was a lot of wait and see kind of attitude in the markets, whether it was stock markets, bond markets, whether it was corporate activity, even the man in the street, wasn't taking on buying new cars or financing. So first quarter, wait and see. Second quarter, free and fair elections, certainly swift formation of GNU and some renewed confidence on structural reform. Bond and equity markets responded quite well. And we certainly saw then a lot of discourse with clients around partnerships and looking for new opportunities. Towards the end of the year, then we saw, loan growth pick up in a few areas, but remain very low. So Nedbank was able to take a little bit of share in vehicle finance and mortgage finance very deliberately. And then we finished the year strongly with renewable energy projects and a really good pipeline coming into 25. So I guess you're right. We thought at Nedbank the rate cutting cycle would be pretty shallow, and that's the way it's turning out. And we think GDP picks up this year. Some of those are base effects. But no doubt we need more infrastructure and public-private partnerships to come to fore. This year, slow start, I think, in the year, probably from an economic perspective, but then it should pick up in the second half.
And I want to get into corporate lending in just a bit. But before we talk about that, I'd like us to look at your revenue line. Net interest income growth muted, while non-interest revenue ticked higher. Just talk me through the dynamics that played out there.
Yeah, so the interest income, without repeating the comments I made on the macros, of course, they play out with respect to loan growth.
Yes.
And I think, Taling, we'll see that across the sector as everyone reports over the next few weeks, that there wasn't much growth out there from a lending perspective. As I said, Nedbank, I think we did well in a few key areas, which was deliberate, in mortgages, vehicles, and then in investment banking. The non-interest revenue, Taling, I always see as a key franchise health indicator. In other words, if you're able to earn fair fees off your clients and grow your fees and commissions, serve your clients well on the digital front, etc., and trade well in our trading business in the investment bank, that's a good indicator of franchise health. It's on the back of many investments we've made, not only in our brand, but also in our technology, in our digitization journeys, etc. So very deliberate there, and we're very pleased with our performance in non-interest revenue.
Yeah.
And as you said at the beginning, that kind of drove our earnings growth. It definitely drove our revenue growth as well.
Okay, let's look at, this improved economic sentiment that we saw towards the second half of the year and into this year. And Nedbank seems really upbeat about corporate lending, and I guess, of course, a function of the better operating environment. Talk to me about where appetite is there. Are we still seeing deployment of funds to renewables, or are we seeing some shift to infrastructure, perhaps?
Yeah, definitely renewables remain a key theme, and specifically for us at Nedbank. We've been leaders in that space for a very long time. And in the last round of renewables that was awarded towards the end of last year, on both the batteries or the solar, I think we and our clients, our partners, won 7 out of 8 of those. And we launched a number of programs in 2024 where we financed corporate clients on their own journeys of energy transition to renewable energy on their own estates. So all of that's intact and remains. I mean, a lot of what I just spoke about now is actually still pipeline for 2025. Okay. In other words, those loans haven't drawn down. They'll come through the balance sheet later. So, there's all that going on. I would say, Taling, that if you think of commercial property, a stable book is a good thing. We saw a lot of distress in that portfolio over the COVID years. We had to book some impairments against those risks. We see lots of stabilization in our portfolio, which is a really good thing. In other words, maybe not great new big loans being drawn down, but certainly a far better situation to be in than we were maybe a year or two ago with respect to risks in that portfolio. We certainly see a diversified portfolio on our side. Even office, Tarling, you'll see that in our office portfolios, there's a lot of people back at office, the vacancies are lower and these types of things. So that's kind of normalizing quite nicely. But then, not just renewables, also projects around water. We were part of an amazing project late last year, which is about a 4.5 billion rand financing of an amazing water opportunity in the Limpopo province. So there's lots going on with respect to that part of our portfolio. We're very good at infrastructure, very good at infrastructure financing, and that plays across the board. Opportunity going forward, of course, is more around logistics, I think. That could be an opportunity ahead of us. And there, I think the sort of opportunity to work with government around public-private sector opportunities is real.
Jason, before I let you go, the group also announced a really big restructuring, right, around the wealth management units and a few other units. Just walk me through the thought process behind that and what the group is looking to achieve.
Yeah, thanks, Tarling. And it's also great to, kind of have this engagement in the context of, a company that's performing well. So the opportunity we see is to organize ourselves around our clients. So this is a client-centric model that we're moving towards. We previously had retail and business bank and then wealth alongside it. Firstly, we actually have a premium brand as Nedbank, and if anything, we want to grow our wealth business. But we're going to create a personal and private bank that will face all individuals or all people in our market, right from entry level up through the top of wealth, with all of the products, all of the capability and all of the distribution within it, including insurance will move in there from our current wealth cluster, and then our Nedbank private wealth businesses as well. And the intention there is to improve our cross-sell and upsell. It's definitely not let's call it a cost-cutting exercise or anything like that. If we find any cost synergies, we're going to reinvest them in the business. And then we've also today announced the creation of business and commercial banking segment. Yes. So Nedbank already has relaunched the mid-corporate fairly recently. We see a commercial opportunity that's large, and you'll know that if there's growth in our economy these days, it's coming more from the SME and commercial segment than the top end or bottom end. And this really focuses our client activities around that segment in a more kind of, let's call it, focused and deliberate manner. It'll similarly have all the product and distribution it needs to deliver. So that's the change. It's really to serve our clients better and over time improve our returns.
Jason, thanks so much for your time and just taking us through the 12 months that was for Nedbank. We'll catch up with you in the next 6 months. That was Nedbank's CEO, Jason Quinn.